One.
So everyone stopped shopping at Walmart and they went to Target, or it's a case of high bar, low bar, leaders to laggards. We'll talk Cisco, Walmart, Palo Alto Networks. Macy's catches a bid. Alibaba getting destroyed, even though some good news out of China. Ryan Dietrich's going to join us at 8:35. He's been spot on. It's Thursday. It's pre-market prep.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
All right, good morning, traders and investors. We're starting out in the red by 9 handles, kind of a weak close yesterday and not the greatest earnings. So here we are, down 8.5 handles at 45.10 and a quarter. The buck bouncing back. I know there's a double bottom from the last two sessions on the dailies, little up 11 cents, 104.38. Bonds recovering from yesterday's hit, up a little over a half a point, just under 115. Crude moving towards the low of the move, down 46 cents at 76.33. And gold up 330 at 1967.60. Bitcoin, or excuse me, silver in the green too by 15.7 cents. And Bitcoin futures are down $580. Not bad after yesterday's big rally. So let's bring in Triple D here. And before we do any market talk here, Dennis,
yeah,
I want you to know that I compromise, right? So this is what I'm going to do live in front of you. We're going to take the first stock of the day, Walmart. Okay, WMT to get the correct symbol.
you're going to get rid of a chart for me. I know what he's doing because I complain about the 4-chart system.
And I'm going to minimize.
I like this. Now I can tell what's happening.
And
but
now
the pre-market. I need to see the pre-market.
I know.
We're going to make it big. We're pre-market
there you
prep.
go.
Big pre-market charts.
There you go.
That's my vote. Pre-market prep shows big pre-market charts. That's what I want to see. That's what I like. That's the new layout. That should be the layout for everyone. Where you got the big pre-market on the left, and then you got the longer-term picture on the right. That's all you need right there. Joel,
you know
we just discovered the new layout. I love it. I love it.
I'm gonna nix that 60-minute chart. I am gonna delete
the
60-minute chart.
I love this new layout. Make that a little bit bigger. Bring it down
all the way down to the bottom.
I love it.
Okay, and then
everybody says they like it so far.
You love the daily, right? But the daily,
I do.
It shows you the net.
And even all that yearly, get the idea for the last 10 years, Walmart's just been going straight up. I love it.
Okay. So I'm going to go.
Everybody likes it.
File.
Finally. Easy Mike says, finally, we've got it. Richard Jones, yes, it's cool. Falling Knife says, I like it. Brian says, it's perfect. Mitch is in the background, and he's coming in. And we want to know if Mitch likes the new charts, because I think Mitch is with me, too. Money Mitch, come in here, please. He's with us. We found the new layout. I love it. We're all happy. Dogs and cats living in harmony. It's awesome. Everything is awesome again.
It's a dog world.
Joel for president. Joel
for president 2024.
I'll tell you, we'll get to the stocks after this. And you said one thing, because during our little spat
Elconin 2024, man. Come on, get it right.
You said, I said, I said, this is the 15 and this is the 60. And he goes, why do you have both? I said, because you want to see the after hours and the pre-market. So what I did is I went to the 30-minute.
Nice.
The 30 minutes.
Now we see it all.
Yeah. Okay.
Everyone loves this. Bill says he likes it better as well. Whoop, whoop, says Brian. We have it all figured out. All our regulars are saying you did it. Made a good call here, Joel. And now you can clearly see the pre-market action Walmart. It is ugly, folks. It is what is called leaders to laggards.
No. What are you talking about, Dennis? This is just the latest rollback sale. at Walmart. You
Mitch
like
with
that one, right?
puns early. It's 8:04. It's too early for puns. Mitch, give
Oh,
us these numbers here.
oh,
What did
we'll roll it
Walmart
back. We'll
say?
give you the discount here. Adjusted EPS here coming in at $1.53, beating the $1.52 estimate. Sales of 160.8 billion, beat the 159.55 billion estimate. They raised fiscal year 24 sales and adjusted EPS guidance. Raised sales guidance, adjusted EPS guidance here at from 636 to 646, now to 640 and 648. Total U.S. comp sales were up 4.7%, excluding fuel. I mean, where's the bad in this report, guys?
That ain't that bad. You know what the bad is? Low bar, high bar. Joel said it right off the bat. I just tweeted it too, Joel. Low bar, high bar. Target had the lowest bar ever. Walmart had the highest bar ever. Walmart was at an all-time high going into this report. Target was basically at like a how many year low. Bring up that Target because we got that information on the right chart too. We were at a 4-year low basically in Target and an all-time high in Walmart. Low bar, high bar. That's the case. That's the story. That is what has happened here. Walmart was going to absolutely need to blow it away after we watched Target rally $18 yesterday. It didn't happen. It was a good report, but not a great report, and they needed a great report. Knocking it down $10, that's significant. But you are seeing this, man. This is what we're seeing: is the laggards of this market, aka Macy's, which we'll get to in a second, are those stocks that they're buying right now. Oh man, these low PE stocks, we love them again because the TLT was having a little bit of fun running up to 90. So it turned us into this whole PE conversation again. And Walmart's just looking evaluation higher, obviously, than Target. Low bar, high bar, that is the case. Joel, spot on.
155.55 is the pre-market low. Way this market's been moving and the way things have happened, I hasten to say that, it's going to hold, but man, it has to thicken up a little bit here on the way down. That's what I'm thinking. So, the dailies don't give you anything. I'm just going to go. Last month's low was 151.65. I don't think we're going to see that today. 2 million shares have traded. I don't really trust that last 30-minute bar because I think that they probably got some APM prints. It didn't really trade back over 162, did it, Dennis? Is it that volatile? Because
I know, Joel. That was probably the 8
okay.
o'clock.
Yeah. Yep. I would just wait for it to calm down on the 15-minute chart. We have the 30 up here, but pre-market low, I'll give that. That's a good level if it comes back down there again. On the upside, who knows where this thing is going to be? But going to take a lot more sellers to push it down. 2 million shares have traded, and wow, it was trading at all-time high. It's such a rug pull for investors and way over the straddle.
PE of Walmart is 32. Forward PE is only 24, but PE of Walmart is 32. That is expensive, folks, for a retailer. It does not really get, unless you're Costco. Costco will have even higher PE. Target PE, 16. After the run. This is after the run. So, I mean, this is just a case of high PE, low PE as well. And right now, they are buying low PE stocks, and they are actually starting to sell high PE stocks. We saw this with NVIDIA yesterday, and that's a bigger conversation. But you're definitely seeing in the last couple of days leadership change. And I don't know if that sticks, but at least it's sticking here for the last couple of days. Maybe we should go to that Macy's report, go off the script here because we'll stick with the retailers here, Mitch. I know we were going to talk Cisco and Palo Alto Networks, which we're definitely going to talk. But let's talk about Macy's because it's a good example of what I'm talking about here. Go to that report.
Macy's Q3 adjusted EPS coming in at 21 cents. This may not be comparable to the 2-cent estimate. Sales of 4.86 billion beat the 4.79 billion estimate. Macy's Q3 comparable sales were down 7% on an own basis and down 6.3% on an own plus license basis. Gross margins of 40.3%, up 160 basis points year over year, and merchandise inventories down 6% year over year. That's one trend that I'm going to continue watching in these kind of apparel retailers, of course, is looking for that merchandise inventory to actually be down. Might actually be a good thing in this time.
I mean, I'm looking at this report and thinking, it's okay.
It's okay.
Not great.
And,
It's
and
okay.
that's fine. That's fine
And
for
when
the
you're a
seasonality
laggard,
time, right?
and when you're a laggard, Mitch, like Macy's, and you're sitting at a multi-year low, which we are. I mean, we're not at the COVID lows, but if you knock out the COVID lows, let's just for a fun thing, knock out the COVID lows when we thought everything was going out of business. So forget about those lows in there. Macy's is sitting. I don't know, Joel. You got to go look at your charts here. Bring it up in the top left corner or top bottom left corner. I mean, if you knock out that 2020 low, how many years has it been since Macy's was down at 11 or 12 bucks? I mean, I don't know. You got to go way farther than 10 years. I'm going to go to a different
Oh
system
yeah.
where I
Oh
can go
yeah.
out to
Yeah.
20
Oh, I
years.
see what you're saying. You're looking.
Yeah, I'm saying knock out that whole 2020 business because they got killed. They were going out of business, and then it took a while for them to come back. So we just knock out the whole COVID thing.
2000, the financial crisis.
The financial crisis, going back to
Yeah.
2007, 2008 was the last time we were this
Actually,
low. 10 bucks.
2000, yeah, mid 2009. This was in the 10 handle in
Yeah.
mid 2009. Just moving
This is the
forward.
definition of a laggard. The proof is in the pudding. This is what you call a laggard. This is right now a laggard market. I don't know if that continues, but for the last 3 days since we got that CPI data, but it wasn't green light, and it was kind of green light by everything the first day, but now it's green light continuing for the laggards, and you're seeing actually some profit taking in the leaders. So I mean, these rotations is what it's all about. This is
Wicked.
how, folks, how you get an edge in your trading. Again, to you long-term investors, it doesn't matter. Buy good companies at reasonable valuations. All you need to do on the long term. But we're a trading show here. Money Mitch is a trader. I'm a trader. Joel has been a trader for a long time, although he seems like a long-term investor as of late. I think we've got to just focus on what trading is. And trading is all about identifying the drivers and the leadership. And right now, the laggards continue to drive the bus here for the simple reason is that they're thinking, hey, rates have peaked, so we have a green light to buy some of these stocks.
14 bucks. 14 bucks is a big level. Okay. It was the gap area back in that was probably August earnings. It snuck over that in a 14 handle. It wouldn't have been there if an institution was there. 14.35. So you've backed off a little bit. There's going to be a lot of paper willing to buy this up a buck off the open. I still like the $14 area. If it gets a strong 14 bid, then you got a gap to fill, and that gap goes all the way up to 14.76. So if you're waiting on that, nice move for Macy's. People sitting on a lot of profits that just did the short-term play here from the last two sessions, Tuesday and Wednesday. Yeah. Let's see if they could care less long-term about Macy's. Let's see what happens at 14 bucks.
And here is the thing. Laggards are laggards. Just one more conversation, then you can move on, Mitch. Or did you have something to add to that?
Oh, yeah, I was going to add to this, but
yeah, go ahead.
So what I wanted to say is just look, I sold the rip on the XRT yesterday. I'm getting to that point where it's just like a lot in 3 days, right? Especially for swing trades, 9-10%, 3 days. I got to start taking some profits. So I took completely the XRT off, and we had this on Monday, not Tuesdays particularly. So now I'm even seeing on this trade, like KSS now towards 25 resistance too.
Yeah.
That was a trade we were looking at it on Monday, a 50% retracement move near that $21.
Right back up. 25 bucks is big there. 25 bucks. 25 bucks. You got to pay attention to that in Macy's. That was your September high. You had 3 highs just under that in November, and then you touched it yesterday. Now you need a 25 bid here for Kohl's. Nice move here. Nice 2 day. Wow, look at those charts. Look at Macy's and Kohl's, man. Those things look
huge moves.
Identical.
Very
absolutely identical.
And that's why we pair trade Macy's, Kohl's, Nordstrom. Like I've got all my groupings. Like basically, like again, for my own trading and why I've been successful for 23 years. It's not because I'm a great technician. It's not because I have information. It's not, I'm basically trading statistical arbitrage. It's what I'm doing. In statistical arbitrage, slow and steady. It's a boring strategy. To 99% of people are like bored with it, when you're talking about little, intricate strategies there, but it works, just understanding how stocks are interconnected and understanding the rotations and understanding, well, these stocks are going to move under these conditions because the market is more predictable in that way. So, I mean, all I'm trading is odds, and that's what I learned at Bright trading all my years. Like, so if I go back just to when I started trading 1996, I was looking at charts, I'm looking at this. I got head and shoulders. Well, I sell the head and shoulders and I buy the cup and handles. And 97, 98, 99, I was just buying stocks. I never shorted a stock back then. And look at what the market went straight up at 96, 97, 98, 99. I thought it was like the market genius that I knew it all. You know, I just don't lose on trades. You know, they all come back eventually. All that stuff. And then I started Bright Trading in 1999, and I realized I knew nothing. And I learned from so many fantastic traders at Bright Trading. Half the traders in 1999 came from the floor. Obviously, the one I learned the most from was Joel Elconin, who's sitting here right now. You know, he had, you know, so many, you know, and he had different ways of looking at the markets, a lot of technicals too. But you understood those relationships as well, Joel. I mean, we talked about, you know, in S&P futures, always the driver then, and listening to Ben Lichtenstein back in the day to try to get a little bit of an edge. So understanding how the markets are interconnected with relationships, that's the boring stuff they don't talk about in the media and on CNBC. That's the stuff that makes money. Why do you think Citadel and Virtue, they're doing arbitrage? Yes, they're doing market making, yes, but they're doing other stuff like this as well, where they understand the interconnections. The bots understand the interconnections to it all too. So there's huge edges in this. So understanding your groupings, like the first lesson I would give to new traders just starting out isn't how to read a technical book.
Group your stocks
It's actually
together.
grouping stocks. Take all your stocks, your S&P 500, and group them. Just put them in groups so you know what moves with what. And then going in. And people are like, what are you talking about? Look at Target, Walmart going opposite. We've got to understand, Target, Walmart are not connected right now. You have a leadership group and a laggard group. So they move around too. And understanding those new groupings, that's how you get the edge over the bots, folks.
This is exactly what my afternoon show is based on. Start swing trade, right? I talk about sectors, industries,
Groupings.
and that's all I point to. Literally, I move backwards from sectors to industries to stocks. Not what majority of traders do sometimes is they come in the morning and they just look at the gappers list. They move from stocks and then wondering why that stock is moving. Got to know your relationships, team. Let's get to Cisco.
Oh,
Cisco Systems Q1 EPS here at $1.11 beats the $1.03 estimate. Sales of $14.67 billion beats the $14.62 billion estimate. Cisco cut fiscal year 24 revenue guidance from $57 billion to $58.2 billion to $53.8 and $55 billion on the high end. Their ad EPS outlook at 4.01 to 4.08. Now from that down to 3.87 and 3.93. They did say on the call that they saw a slowdown of new product orders in Q1. So this is definitely affecting them. And it looks like this is going to be a little bit of a key reversal here, as the monthly chart was actually looking pretty decent as it was starting to work its way back. But now
a little bit of leaders
down.
to laggards here too. Cisco has been a leader, and you can say, oh, well, it's off the highs, but really it's not off the highs like a lot of other stocks were off the highs. Leadership, some tech leadership. So a little bit of that here, but a little bit they just lowered guidance. I mean, when you lower guidance, you get hit, especially when your stock is not sitting in the gutter like Target was sitting in the gutter. Again, understand your relationships too. So before we get in the relationship talk, I said I did make a bad trade in this one. Again, you know, I make bad trades lots of times. I make bad calls. The reason, you know, I'm successful is I'm pretty decent at working out of the bad stuff, but I got run over in Cisco. I was trying to be a hero, Joel. You always tell me, don't catch a falling knife. Wait for the first green candle. I couldn't wait. It was down $6, and I'm like, oh my gosh. I'm like, they're going to bounce this. They're going to bounce this. So I bought at 47.5, and it was 45 in my face. Like it felt like 5 seconds later. It was about a minute later or 2 minutes later. And I'm like, man, that was just stupid trying to catch the falling knife. It bounced up into the 46 handles and I worked out of it. I ended up losing $1. It's back at 47.5 now. I know. So your retail trader normally, oh, you don't sell a loss. So it came all the way back. But a lot of times they don't. So you've got to cut those losers as best you can. It was chopping around like crazy. So I ended up losing $1 on it. But it was just a bad call trying to catch the falling knife. And
well, the other reason you pair out of it is your opportunity cost. Like you're stuck, you're wrong, right? And what are you going to do? Sit there and worry about that trade? So
And this is a fantastic point too, Joel. The opportunity cost I talk about all the time. It was kind of a slow night, so I normally wouldn't trade Cisco. But there was like really reporting last night with Cisco and Palo Alto Networks. And it was kind of a slow night. Cisco was driving the bus. So I'm like, let me dab and just do my good tape reading skills here. And it wasn't even about tape reading. It was just down $6. And I tried to be like, it's too much. Tried to be the hero trade. The hero trade usually a zero trade. Don't be a hero. Don't try. So that ended up, costing me some money there. Deserved loss.
I'm a little disappointed in myself because I've had this for long term, and I don't know how many years I've had it. And when it
You're like
had the
Warren
nice,
Buffett over there.
yeah, it had the nice run, and then I got concerned on this day here. They did a big acquisition, and and to me the street just didn't like it at all. They rendered their opinion, and I thought, man, if this doesn't fill the gap, if this doesn't, get back into this area, I think it's time to let it go before the next earnings report. And I didn't. And then you had all this daily resistance, so the street had some big sellers. Now, I mean, I don't know what the heck to do with it. I mean, maybe if it ever comes back to fill that gap at 53, I will do it. But pre-market low 44.70. I don't think you're going to see that. Boy, nothing on the monthlies. I'll give 2 month 46 handle. If you get under 46 today, I'd say look for some bids to thicken up pre-market, and then I'd say 48, just under 48 is resistance. So then that's just based on the 30-minute chart. So whoever scooped it up under 47, they're trying to wiggle out just under 48 here in the Cisco kid. Very disappointing here.
Alibaba with some trouble ahead as Alibaba's group
Ooh.
holdings Q2 adjusted EPS at 27 cents. This was up 21% year over year. Sales were at 30.81 billion, up 9% year over year. But then they said that newly expanded U.S. export controls rules may materially and adversely affect its cloud intelligence group and could more generally hinder the business by limiting their ability to upgrade technology capabilities. So looks like the battle between China and US actually starting to affect some of these China stocks.
They actually killed the spinoff here too. So the big news, and I do
Yeah,
believe this is a big reason why the stock is down. They scrapped a cloud business spinoff, citing U.S. chip curbs was the reason for that. So they did announce a dollar dividend as well. So it's had some good stuff here. But the spinoff, I think, is really clouding it as well. Huge support, Joel. Go on
Oh,
that
I
Baba
know.
chart. This 80 is just absolutely enormous. Like, we have bounced off this 80 a half dozen times in the past. So support is support until it's broken. And, the old NVIDIA undercut and rally trick here, you wonder if you don't get something like that here too. So I actually think I might be a buyer of Alibaba on this dip, although I'm probably going to wait a day and just see, if we actually do get the undercut and rally.
Man, and this is you had all the nice talk yesterday between Xi and Biden and these stocks. It was just kind of like a Saudi event, right? Like Xi's coming over here. He said, we're not invading
I saw bad
Taiwan.
talk
He
there.
said some good stuff.
I
I
saw some
know.
bad stuff there though. You
What
guys saw
else
good
didn't you
stuff?
like? No, what didn't you like?
I didn't like when he told Biden that Taiwan was the biggest, most dangerous issue in the U.S.-China ties. And then Biden responded by assuring that Washington was determined to maintain peace in the region. I think he was trying to tell him there, like, leave Taiwan alone because that's our business there. And if you want to step out of that and we'll be cool with you, go ahead and do so. But if you want to keep protecting them, we ain't going to be friends.
Yeah.
Well,
And
he
it's
also
difficult.
said they
When we
weren't
know
going to
Xi,
attack.
you can't believe
Yeah.
everything he's saying either. So
That's true.
what's he gonna come over, and say like, oh yeah, we're invading Taiwan, it's imminent here.
I mean, I think he gave
like,
him an out. He gave him the out there, like, hey, if you want to step out of it and not protect them, go ahead and do so. But I don't know, man. I don't trust China one bit.
No, I don't either. I don't
There was
trust
a
him
run
either.
up into the news event with him coming over, and then Baba releases this today. So investors are just upside down if they were chasing that move. Dennis talked about the longer term support here at 80. You did trade lower in the pre market and after down to 79.20. So I think Dennis made a good point there. Give it a day, let it breathe, get a couple lows, see if you can establish a couple lows in that area. But Alibaba down $7. So big move, trading 80 or 88 yesterday, and now in the upper 70 handle.
Palo Alto Networks Q1 adjusted $1.38, beat the $1.16 estimate. Sales of $1.88 billion, beat the $1.84 billion estimate. They do see Q2 adjusted EPS $1.29 to $1.31 versus a $1.25 estimate. And total revenues on the high end also above the estimate here. Also total revenues also above that estimate. So not looking too bad on the report here, but definitely taking a hit.
Leaders to laggards, laggards to leaders. This is the market that we are in right now. Palo Alto has undoubtedly been a leader. I believe it came close, didn't quite touch a new all-time
Oh,
high
look at that.
yesterday,
Wow.
but within a buck of the all-time high. And there's major resistance up there too. So, I mean, it's just not the play right now at this moment in time to be buying stocks at all-time highs going into reports. It's been the play to buy this trash into the reports because those are the ones they seem to be buying. So I do think Palo Alto dip eventually gets bought. I'm not going to do it on day one because his leadership change is spooking me a little bit. But I think you keep an eye on this. I think Palo Alto is a great company, and probably eventually the dip does get bought. But I'm not buying today.
Mentioning that gap in here, I don't know how relevant it's going to be. 254.60 was the bottom of yesterday's range. So if you get a look at that, then be a little bit surprised. But I'm just not going to look at the monthly either. And this is, just pre-market action, after hours action right now. I'd say 240 to 245. I know that's tight range here for a stock that's had a big move, but you've had buyers here at 240. So that is 1-star support. I don't think we're going to see the pre-market low of 226.08. And I'd even go lower than that. I'd say you got to clear out this 244 seller here for the last 2 hours. So it's tight there. Pick your poison between 240 and 244.
What do you guys say? Bath and Body Works, or should we talk some oil?
Do Bath and Body Works. It's fun. We'll do that one. Sure.
All right, let's go to it. Bath and Body Works, of course, it's a kind of a seasonal time for this. Get your candles, right? Q3 adjusted EPS 48 cents, beats a 35-cent estimate. Sales of 1.562 billion, beat the 1.56 billion estimate. They now expect 23 net sales to decline 2.5% to 4%, with a previous view of a decline of 1.5 and 3.5%. So not looking that great on that outlook.
No.
They did raise, though, their lower end of 23 adjusted EPS outlook. But, yeah, that net sales decline doesn't look the best.
And not a great guidance, and they're never going to buy the stocks usually when the guidance isn't great, or even passes. It didn't really even pass, but it's not getting killed. And the reason it's not getting killed is it's already been killed. I mean, the stock is beat up. It was $80 a year and a half ago. It's $31 now. It's definitely the definition of a laggard. So with that happening and laggards still holding up well, I don't know if I'm trading this one because the report wasn't.
Yeah,
passed.
it's kind of
it's kind of like a curveball. So sometimes just don't swing at the pitch.
What you need to see here is let's see. I mean, the pre-market action or the after hours action, we dipped under 31, but I think the setup here is at yesterday's low. Yesterday's low was 32.11. Someone better make a stand there, right around 32, 32.10, and maybe you could see that closing price right there. Minor resistance at the mark, 32.50. I would just look out if it loses, if it opens at 32 and is heavily offered, because the next day's low is not until 30.74. So make sure if you're trading this one that you get a bid at 32 off the open.
All right, guys, at 8:30, we will be getting initial jobless claims. Consensus
Their number
is
every day?
220,000, prior being 217,000. Get ready to go
Are you
wide,
making me go
baby.
wide on this, Joel? Do I have to go wide?
No.
I don't know,
What
man.
if the jobless claims spike? Is that like
the last like 5 job reports, I would have said maybe don't look, but the way that the numbers have been reacting with
I'm
the market
scared.
the last 2 days,
Oh gosh,
you never know,
go
right?
wide
So
again.
yeah, time to go wide, baby. We'll see what happens here, of course, as we get the numbers are going to come in just a second here. And we'll see if things change tunes, right? I don't know about you guys, but I'm even starting to feel like this rip is a little bit too much. I was talking about historical RSIs yesterday and how there's so many stocks that are overbought now. We went from extreme oversold Now we're extreme overbought.
In the snap of a fingers, we went
In
from
a
extreme
snap.
oversold to extreme overbought. I mean, the QQQ rally. So I was looking at a tweet yesterday. I don't know who it was from. It took 3 months for the QQQs to sell
Ooh,
off
look at
that
that.
14%, and it took 3 weeks for it to get it all back. That's unbelievable. I mean,
Look at
that
that.
under
Monthly.
yeah, if you were puking out your portfolio and looking at it in October saying, "Oh my gosh, I got all these crappy stocks," I mean, you're getting
You
a
hate
great
everybody now.
opportunity, a great opportunity to lighten up. I did not
388.
go
Wow.
wide. I stayed out there. Algos picked me off. Citadel, lick your chops.
It moved. Dude,
A
that thing
little
went
bit.
We're popping.
440.
We're
We're at
popping.
50
Probably a
cents.
weak number
Fine.
here. Probably a weak number on the
All right,
job
I'm going wide. You
claims.
spooked me.
Yeah,
right.
it started moving, man. The markets were moving there.
You're spooking me.
45.17. We're back. We got back halfway on the session.
What's the
The
number?
All right,
close.
I
The
got it
close
here.
19 and a quarter. 19 and a quarter. Let's see if we could get green on the session.
Initial jobless claims coming in at 231,000 versus 220,000 estimates. So a little bit hot there. Then Philadelphia Fed Manufacturing Index at negative 5.9 versus a -9 estimate, -9 being the prior. Some import prices also coming in here, -8% versus a -0.3 estimate. So not good there on the import. Let's see export here, -1.1 versus a -0.5 estimate. Also a little bit of a negative there on the exports. But hey, you guys see it.
Slowdown?
Market's
Is
actually
this a
reacting
slowdown?
to an up move.
Are they actually rallying on? We're starting to show a little bit of a slowdown here.
Yeah,
I think we're
yeah,
starting.
that's what I see, Dennis, too. I don't think you're wrong in that thinking
Bond's
immediately.
got to
Because
pop off this. The 30-year bond, Dennis, if you were keeping the eye on the TLT,
it would
that
pop.
had a nice
That
spike
drives the
here.
bus.
Yep, that drives the bus. The all important number is a little bit higher for the bond market, and that is an exact double top at 115 and 23/32. We'll keep an eye on that for the TLT. We got to keep an eye on. Ooh, we're back above 89 here, 89.50. Your number for the TLT equates to 90.16. So the bond market pulling up here. Here, I'll make this the pulling up the equities. I think today is a pretty important day for the market, Dennis. I
It is.
mean,
It is.
not
Yeah.
great earnings reports. We had a higher close, but it didn't feel like that strong of an up day. So I think the close, if we could get it green today, then man, I'll be like, whoo,
Yeah, I'll be stunned too.
4,600. Here we come. Just feels like it's a little thick out
At
there.
what
with
point in
offers.
time does bad news actually become bad news, though? Because jobless claims going up, like we're going
I
to
like how
buy
Paul
on
said.
that. That's a
Maybe
good
in
thing.
January it'll change. He's
Yeah,
seeing the
Paul,
next year.
you're right. Like at some point in time, bad news is actually going to become bad news, because my prediction is that we do go into recession in 2024, that we do see a slowdown. The economic data that's coming in slowly right now is starting to show that slowdown. Even when you see the CPI, a little bit light. Well, why is it light? It's light because of higher rates. So
Spending,
higher
yep.
rates are starting to show up. So I think eventually bad news will be bad news, but right now they're still plotting bad news, good news. This was kind of in line too. It wasn't like, oh my gosh, the jobless claims number. I mean, it's a little bit high. So where can I get a Benzinga t-shirt? Look right here, baby.
Swag.benzinga.com.
That's the one thing that has really kept me out of the full-blown recession camp, for the last couple of years. If we talked about it on the show, is like, when is the unemployment going to turn? And
That's true.
yeah, that's it. And I know. My drive-through indicators at the fast food restaurants is not. I mean,
They're
there's
still
not
busy,
flying.
man.
No,
making
it's
money.
slowing down. It's slowing down. They're only like 3 or 4. It's not like it was. So I know people are running out of little pocket change. But what is important is we got Blue Putnam coming on tomorrow, and
Oh,
Blue,
Blue will tell us what's up.
yeah, he was
Our
pretty.
boy Blue.
He was pretty
You're my boy,
spot
Blue.
on.
My
He
boy,
was
you're
pretty
my
spot
boy.
on when we had him on last time. So we'll see what he thinks.
He's always spot on. We love Blue.
Well, there is
a
somebody
great
in the
PR
back that
candidate.
I would think is really spot on, right? We know who that is, right? We call him the stat man. Some people, and I gotta say, he's always the man that comes prepared with the stats, right? It's not
He's got
just,
the
you know,
stats.
off his mind. He brings the charts. He brings it all. And if you guys aren't following this guy, then you're definitely missing out. Who would that be, chat? Throw it up in the chat if you guys got this one. I want to put you guys to the test. You might have heard it earlier. Let's get to the action. You guys know what time it is. It's time.
Statman time.
Good morning to Ryan Dietrich, Chief Market Strategist at the CarsonGroup. Guys and gals are going to be very disappointed at this next segment because we're just going to talk about the game. Macy at Ohio State game.
Here's the question. Do you keep the stats of the games as much as you keep the stats of the stock market? Because you're the stat man of the stock
that'd
market.
be interesting.
You know, so I don't gamble if that's what we're getting at. No, when it comes to sports, I cheer. But my son is 12, and I'm looking at him like either he's going to be like something else or he's going to be a bookie because he is all about that, the cover, the spread, the over, the under. He's obsessed with Iowa, right? Everyone's obsessed with Iowa because Iowa keeps winning, yet they never score any points, right? So he's obsessed with how Iowa keeps coming in at the under. So we'll see. But anyway, that's not a recommendation to gamble. But just it's fascinating. Yeah.
Give me one comment on the Michigan Ohio State game, and I'll give you one comment, and then we can debate this offline.
Yeah, I mean, Ohio State's defense is light years better. They've given up only one 40-yard play all year. Last year, they gave up it felt like 7 every game. So their defense is better, and it doesn't give up many big plays. So that's a better thing than last year. I'll put it that way. Although they don't have C.J. Stroud. So, hey, you give and take, you know. Yeah.
Okay, my one comment is just we got to contain Marvin Harrison. I mean, if that guy has over 100 yards, we will lose the game. I mean, I think our offense is good. He is the real deal. He hasn't scared me, I haven't seen a player like him in a long time. But all right,
I mean, believe me, I've watched Ohio State 30 years of my life. He's the best wide receiver. They have some good ones. But I know we need to get into this, so let's get into it.
So when we had you on before,
yep.
We were crying, the market's going down, but you were like, no, we're going back up. So we went back up probably a little bit faster than you thought. Where are we at on this rally?
Okay, here we go. Share screen. Tell me you see that. We good?
We good.
Got it.
All right, perfect. So yeah, I mean, I came on, and now let's put this. I know, sometimes maybe some shorter traders listen to this, but bigger picture, after the first 7 months of this year is the best start to a year since 1997. We said, listen, August, September could be some indigestion. Clearly that played out. We did not expect October to quite be as weak as it was. Nonetheless, the war happened. The yields continue to go higher. But one thing that in the first chart here, same as ever, right? On the left, I've got just over the top bearish sentiment that we saw at the end of October. It really felt like, everyone, a marketing correction, everything's going down. It's the end of the world. That is a survey in Barron's of advisors, but asking what their clients felt. I get to work with advisors all the time. Let me tell you, the 12% were bullish a couple weeks ago. It felt like maybe even less than that. I mean, nobody was bullish. And what does that mean? Well, the average year on the right bottoms on October 27th. And I know there's lots of things. I shared some of these charts with you guys last time I was on, actually, seasonality charts. So listen, choppiness now makes sense. Late October into the year would also make sense for an upward bias. Clearly, that's kind of played out. Now, I've shared this with you guys every time for a year. I'm going to keep sharing it, I guess, because it has worked out. This is the 4-year presidential cycle based down on quarters, broken down on quarters. The best 3 quarters were the fourth quarter last year and the first 2 quarters this year. 7% gain, 7% gain, 8% gain for the S&P 500. The third, so that's when stocks should be strong. Stock should be kind of weak in the third quarter of a pre-election year. Well, that's kind of played out. And then to see some strength in the fourth quarter is perfectly normal. But here's where things get interesting. Let me skip ahead. I'll jump back. We knew coming into this year, it's a pre-election year. Everybody under the sun talked about pre-election years being strong. Yes, but nobody really had optimistic views on the market a year ago right now. We came into the year saying no recession, about a 15% gain on the S&P. People thought we were crazy for saying that, but it's kind of played out. And this is one of the reasons. We've never had a recession in a pre-election year back to World War II. All right, you've never had a recession when you made 5 million jobs the year before. In fact, we've never made that many jobs before. When you make 3 million jobs, the next year is like never had a recession back to the 70s. So some reasons to think there's no recession. Stocks maybe do better, but here's what's interesting. 20% when you have a first-term president like we do now. But check it out. Midterm years under first-term president aren't that great. That played out. Here's what really is important, I think, for investors. Next year is an election year. We're going to hear about 2000 and 2008, horrible years for stocks. Yes, they were also election years. They're also lame duck presidents. And I'm not saying the president changed what happened in 2000. I guess it'd be President Clinton because of the tech bubble, and obviously President George Bush too because of the financial crisis in 2008. But what I am saying is when you have a first-term president, the stock market's up about 12% those election years. And check this out. Never been lower the last 10 presidents. I mean, it's one of those, it is what it is. You don't blindly invest in this stuff. But when you put all these blocks on top of each other, is one of the big reasons I come on to you guys a year ago saying, hey, we could be in the midst of a pretty good size overall run. I get small caps and mid caps. We can get into that stuff. But overall, the market's done pretty good if you've just been a, kind of a buy and hold investor. And that's just something I think interesting. What did I have? We'll just keep going. The Zweig, I'm guessing you guys had some guests talk about this, but we had that Zweig breadth thrust. Keep it simple. When you're super oversold and then super overbought within 10 days, that triggers. I've got some data back from Ned Davis back to 1920s. It's only happened, you can see 14 times since 1950. Again, it is what it is. You see the return 6 months later, pretty strong. A year later, never been lower. So let's just check that off. And I get the argument, and I can't disagree with this. I talked to Ned Davis about this. Used to have things traded in eighths, right? Remember that? Now it's in pennies. So it's a little easier to get a lot of all the stocks moving the same way. I'm still saying I put this in the bullish camp. We've been in the rare camp saying the Fed is done for a couple months now because inflation's coming back. Now, finally, right? Finally, people are agreeing with us. The one on the left I want to focus on, that's private data on rents, right? Zillow, apartment list. I've got apartment list there. Zillow looks similar. We know rent prices soar. Well, let's just think about this. Housing and used cars make up about 55% of core CPI. Used cars have been negative year over year, 14 months in a row. We just had a big drop in Manheim used car index again. And we've seen finally, we saw the private data. This is one on the left now. Private data has been saying one thing. We just saw some things crack on shelter, I think, in that recent CPI number. That's why the market went crazy on Tuesday, in our opinion. One of the literally the strongest breadth days we've seen in years, like all time for small caps practically. 97% of stocks in the Russell 2 were up on Tuesday. That's, to me, not a bear market rally. That's a little stronger and probably a good thing. And I come on to you guys for a while saying we are overweight small. Believe me, we started in the middle of the year. Believe me, it's been uncomfortable, but this is why. Because we thought inflation's coming back. We thought the Fed was done. The stuff that's gotten beaten up the most is probably going to do well this year and even into next year as the Fed is done. We think the Fed's going to start cutting, which I'll talk about in a second. I know probably need to move forward. Down 3 months in a row coming into November. And I get it. Some of the stuff I mentioned in October didn't work. It didn't work. But still, I wouldn't ignore some of these seasonal things. When you're down 3 months in a row, November's never been lower. Hey, this November is off to a roaring start, obviously. December, usually a little follow through, and the rest of the year is usually strong as well. What do I have here? When you're down in October, but still positive for the year, similar numbers, right? Pretty strong November, pretty strong final 2 months again. Now, I think this might be my last one. I'll spend a minute on this and we can talk. I think one of the key things will be in our outlook that we're producing right now. Again, our outlook last year, we said no recession and still strong bull market, right? We got some funny looks for it. We still think we're probably not going to be as strong in equities next year, but we still think, stocks are going to do a good deal higher when all is said and done, potentially low double digits when all is said and done. But productivity back to the 90s. In the mid 90s was the last time we had really strong productivity. You know what happened in mid 90s, everyone? 94, the Fed hiked rates. Bonds didn't do so well. 95, February 95 was the last time the Fed hiked. And then the market sniffed out potential cutting. The Fed cut. And you know what happened? Wages stayed strong, inflation stayed low, productivity was high. Productivity is the key to this whole thing because we haven't seen productivity for a while, right? You can see the numbers here, the annualized. Productivity hadn't been as strong. The last 2 quarters, productivity's run at 4% annualized. We think next year, into next year, we're going to have stronger productivity. This is key to the whole thing because more productivity means you can pay higher wages, but inflation is capped. In the 70s, had massive inflation, massive wages. We had low productivity. So again, this is kind of putting I know I'm talking macro, big picture views. This is how we see the world. So when we have these 10% pullbacks, we have these 5% pullbacks, we use an opportunity. We manage real money. My team manages real money. We added equity risk twice this year, in March and in late October. Okay. I mean, so, we're putting our money where our mouth is, so to speak, with a lot of these big picture things. There's no recessions. They're still strong. And if productivity stays strong into next year, follow those numbers. It's bigger picture for the more, intermediate term, the longer term investors that don't panic when we have a normal 10% correction, because that's what we saw a few weeks ago. Everybody panicked. Well, I'll take a breath. There's a lot there. What do you guys want to talk about? If you want to talk, I'm good with
chat saying, I'm saying you should have been an auctioneer.
I advise everybody to play that
if you
back.
weren't so good at markets, you've definitely got a career in being auctioning, because Nobody could speak more clearly and quicker than Ryan Dietrich. I talk
I
pretty
want his
fast,
coffee
man,
brand
but
too,
he puts
man.
out
I don't-
so much
I don't drink coffee.
information in
I don't.
4
This
minutes.
is
And he
this is
always
water.
makes me feel better because, I start getting a little bit bearish. Ryan comes on and smacks me in the face with some stat. I'm like, you know what? It kind of makes sense. This guy makes good calls, man. So you know what? You got to listen to Ryan. Honestly, unbelievable 5 minutes of information there. You got to replay that 3 times to catch it all, though. That's great, Ryan.
It felt longer than 5 minutes. It was only 5 minutes. I tried to fire.
I think it
Now-
was only 5 minutes.
Well,
All right.
you
A
showed
lot
the
there.
presidential cycle. We've seen this a million times.
Mhm.
I love that
Yep.
you always bring this back up because it's important, right, to just continue on that trend so that you guys can see it also, the audience. Now, of course, one thing that I do catch on there, though, is that Q1 in year 4 is usually statistically really weak, right? Are we expecting to see a slowdown going into January?
Yeah, I mean, we wouldn't be too shocked by that. Like you said, you can potentially see that a little bit of weakness. I mean, honestly, January, I know this January was strong, right? We had a 5% jump this January. When you have a big drop the year before. We've seen that slingshot effect. I think it was like up 25% on average previous years when that potentially happens. But lately, January hasn't been that strong. February is one of those weak months. So yeah, I mean, we have a ripper of a year-end rally, and we do think that's still the case with some of these breadth thrusts and things that we're starting to see. November 2nd, and then I guess it was 2 days ago. So November 14th, those were 2 historically strong breadth days. You want to see some of those kind of close together. It's November, it's that year end. So if we get a little year end chase, maybe we could see some weakness. But again, to us, it's not overly concerning. And here's one more thing. I mean, presidential stuff, don't shoot the messenger here. What I was talking about earlier, I mean, markets can do okay because normally a first-term president wins. I know it's not perfect. I get it. But markets don't like what? They don't like uncertainty. Well, who's probably going to run here, right? One president currently sitting, one president who was the president. Is the market going to be shocked with anything? I mean, it's always a shock, believe me, but is it going to be surprised? Maybe not. And I think that's one of the reasons why markets do a little bit better, into an election year, because there's probably less uncertainty. Because there's not probably going to be a new person sitting in office. This time it might be the older guy or the older guy. It's kind of how it's going to be, right?
Ryan, what if we don't get those rate cuts? I mean, I know Goldman and Morgan were arguing about, they're going to do this, they're going to do that. Personally, I mean, rates are steady, people are making money here. How does this scenario change because if they start to lower rates, that's going to be because we're slipping into a recession. If we're slipping into a recession, then that's bearish. So talk to us about if there's no rate cuts.
Great point. I mean, so our take there, and I said it really fast. If productivity is high, we don't think there's going to be a recession, right? We think this is more normalizing. So in 95, 96, the Fed cut because, again, the economy was on firm footing. You had higher productivity. Greenspan understood higher productivity means you can cut. Maybe remember in 94, they raised rates a lot. What happened? Orange County went under. We raised rates a lot this time. What happened? SVB and the financial crisis. So you can upset that apple cart when you hike rates more than expected. But again, we think they can cut rates later this year. Not a bunch. I'm not saying a bunch. Believe me, they cut rates 200 basis points. That's probably a bad thing. It means the economy is drastically slowing. We think the economy is more normalizing here. But I'll just, to kind of answer your question a different angle here, though. If the economy continues to strengthen, that could be inflationary, right? I mean, so if you have a really strong economy going forward, but we don't think it's going to be a rip-roaring economy. I think it's more just normalizing. Everybody's freaking out about the jobs numbers. Well, we averaged 400,000 jobs a month last year. That's not normal. Between 100 to 250,000 is a little more normal. We think that's just kind of the path to normal. This is kind of what we called our outlook 12 months ago, right? Getting back to normal. These are all just part of the process, but if productivity stays strong, they can cut, and it's not going to be because there's a recession coming. That's our base case.
Wow.
I'll jump in
So
here.
much to take
We were leading you up.
I thought I lost my internet. I stumped you guys.
Dennis
Dennis
normally
is
is
up.
loaded.
I'm speechless.
Dennis is
There's so much
normally
information
loaded,
to take in here,
ready to
though.
go. Joel and I were like, "Where's Dennis here? This is normally Dennis's spot here."
I know. Usually I cut in here, and I'm like,
I
just
think
speechless.
what it is,
Go.
Ryan, is you're turning Dennis here. Dennis is right now like there's like a little bull on the left shoulder
This hard
and a little
landing may
bear
not
on the right
come.
A
shoulder.
little Dietrich over here and a little bear
A little
over there.
Dietrich over here, a little Peter Schiff over here, and I don't know who to listen to.
A little Tom Lee.
Yeah.
All right,
I never Tom Lee. I'm not a fan of Tom Lee, but
I know that one. I heard
he's the only
Dennis
person
there.
out there that I'm really not a fan
All
of.
right,
But
so Dennis, you've been thinking about that we could go into recession, right? Expand on that mentality and talk to Ryan here why you feel that, and I'm sure Ryan has some stats here to back up his side.
Well, again, I'm just looking, higher rates here, and I
Mhm.
don't see them lowering rates until we start to actually see an economic slowdown. And maybe it's not necessarily a recession, but I just feel like that, and again, I don't look at all the data that Ryan, and you're fantastic with the data. I just kind of look at the big picture here and think
Yeah.
higher rates for longer eventually hit. Like Canada is in an official recession right now. We've had 2 consecutive quarters of negative GDP. Canada's a little bit different situation because Canada, basically the banks only give out 5-year fixed mortgages. So it's going to hit Canada first, this slowdown, because all of a sudden, we're like a year into higher rates. While this slow trickle of people, oh, my mortgage is coming due. I'm going from 2 to 8. And now I'm like, I got to cut my spending here. So maybe the U.S. has been cushioned because obviously everybody's sitting on these 30-year fixed, and it's been cushioned a little bit more. But I mean, when I'm looking at, what's happening around me in Canada, maybe it skews me a bit. It is starting to slow down here a little bit. So thoughts just, on how, the consumer, obviously has navigated higher rates for the short term, but can they continue to navigate these higher rates? If rates do stay higher for longer, if they do, does it not eventually equal some type of a slowdown?
Yeah, no, it does. I think it needs to slow down. I mean, just literally today, okay, I'm going to CarMax. My daughter turned 16 a week ago. We're getting her a car, and we're doing the financing thing. And I'm like, wait a minute, how much am I supposed to pay a month here? And
I
it's like
know.
it's real world. You realize, oh, I got a car a few years ago. Whoa, this is like a couple $100 a month more, and it's the same price car. So it's real world when you see things like that. But at the same time, the consumer. I mean, they continue to, at least in the U.S., almost like showing no signs of slowing down. And I get some of the cracks. I mean, the Fed just had the study a week ago that showed some of the delinquencies, 90-day delinquencies are starting to creep up a little bit. But then you take a bigger look, it's just kind of where we were pre-COVID, right? So again, is it normalizing or is it slowing? I think is the big question. We'd say it's more normalizing than anything. And here's a couple other things for you. I mean, literally, the consumer is one thing, but the truth, balance sheets in the U.S. for big corporations are in really good shape, right? I mean, like half of all debt is fixed for small caps, right? So that's why small caps been hit so hard, because the other half isn't fixed. So as rates go higher, debt costs more. Large cap companies locked in a ton of debt. Remember, Microsoft locked in things like 2.6%. Now you're making 5.5%
Oh, I
of money
know.
market. So the truth is, balance sheets for big corporations in the U.S. are really good because they did a good job by locking in debt. Maybe it was smart, maybe it was dumb luck, whatever it was. U.S. corporations are still in good shape, and those drive profits and can do things. I know the consumer matters. I get it. But one final thing here. If, let's say, we do get a rate cut or two, what's that going to do for housing? Housing's like 5% of GDP, but it's on steroids, okay? Housing's come crashing down in the U.S. and other parts. I get it. But I think people are clamoring to do something there. So that's one part of the economy that 9 quarters in a row, negative GDP from housing. We just got a tick of GDP growth in housing actually last quarter. Like I said, it's third quarter data. Who knows? Maybe we get a little more housing data growth because we clearly haven't been for 9 quarters with what's happened with the Fed and interest rates.
Ryan, what could happen that, I know you look at your data over long term here, but is there, what would turn you? I mean, I know you're very entrenched in your statistics, but things out of the blue, I guess a couple wars aren't really bothering things here. Big uptick in inflation. What do you see as a potential
Yeah, end of
negative
the day, I kind of
catalyst?
say I follow the credit markets, right? I mean, if we're not seeing, I mean, we heard about this credit event. People were talking about this a few weeks ago, yet triple B spreads, investment corporate spreads, they weren't blowing out. They were a little bit higher, yes. So to me, if there's a monster under the bed, the credit markets and credit spreads are going to show it. We look at that every single day. We're with a really smart guy named Sonu Varghese. We do have, hopefully it's okay, we have a podcast, Facts versus Feelings, a weekly podcast. We break this stuff down. He looks at all this macro stuff, and he just continues to see real positives under the surface. So Sonu starts to see weakness, and I'll talk about it. If he tells me he sees it, we're not seeing it yet. And we see stress in the credit markets, then we probably change our tune from saying we were overweight equities the second week of December last year. To say people hated when we did that would be an understatement. And then the market rallied and people keep making fun of you and yelling at you. And then they get a little quiet, when you have something, when a year like this takes place. And I'll be honest though, the other big wild card for us, we still like small and mid caps, and we've liked them since the second half of this year, and they haven't really worked. But some of these big themes I just was talking about, the Fed is done. If yields go lower, we've seen what's happened, right? We saw that rally in small caps. And we're optimistic that small caps going to show some alpha, at least in the first half of next year. And that's how we're positioning the portfolios of models we run for our Carson partners.
Yeah, I mean, I've been in these small caps, and they've been an epic disaster. Like, not to say they've underperformed. They've been just disastrous, Ryan. I mean, October lows were breached. Small caps are sitting at 2-year lows, really. So, I mean, is the catch-up trade coming? Or if the rates stay high, is this just another rally to sell?
Mhm.
Because I go back to your balance sheet
Yep.
comment here too. I know we're keeping you a little bit longer. I mean, the mega caps, do have the great balance sheets, and a lot of these small caps don't have the great balance sheets, and a lot of these small caps maybe can't handle higher rates for longer. So I look at this
Mhm.
rally in small caps and thinking maybe I should dump some small caps, and maybe I should start moving back into the mega cap tech. I mean, what are
Mhm.
your thoughts there? Because it's been a really nice rally in the IWM in the last week.
Oh yeah, I mean, yeah, historic rally, I think, really for small caps. Also you look at IWM versus Russell 600, right? IWM, even though it's Russell 2000, there's like what 1,600 stocks in there. A lot of them
Yeah.
don't make any money. A lot of them are junk, right,
Yeah.
so to speak. But the SP 600, a lot of those are making money, and that's actually outperformed the last couple of months or so. So maybe there's a little signal there. But I just to be honest, Dennis, we're still thinking small caps are a place to be. Mid caps, we like mid caps too. I get so choked up talking about this.
Catch up trade.
We do think those are still areas to be in. Maybe wait for a little pullback after this huge rally, but we're optimistic that was the low. Recent Tuesday, really Tuesday. I mean, that was the low. We think there's going to be a change, and the seasonal stuff. I know JC's talking about this, and who else? Almanac Trader. Like the next 6 months, small caps do really well. I mean, it is what it is. So that's just some seasonal things to be aware of. Boy, they sure did terrible when they weren't supposed to do so well. So seasonals are lining up. And here's one thing also. If you talk about what's cheap, right? Listen, big cap tech still isn't cheap. Big cap communications isn't cheap. You know what's really cheap? Small caps. They are historically cheap. Now, listen, I've done this 22 years. I've heard for 22 years, EM is cheap. EM is cheap. It didn't always mean you wanted to go into EM. I get it. But if you're looking for something that's cheap, you're looking for something that has a driver, which is a Fed that's done, is probably going to start cutting next year with an economy that's not going into recession because productivity is higher. To us, small caps, and again, final comment. A year ago, who wanted to touch tech? Not very many people because it was terrible. I get that feeling with small caps here, so small and mid. So again, it's not like we're making this huge bet. I want to be very clear here. We're just doing little overweights to small and mid in the portfolios we run. Believe me, we've still got some large cap exposure out there. We just think that's where you're going to find some alpha the next, call it 3 quarters or so.
Remember when Jason came on a few years ago and he said that he listens to videos in like 2x, like double speed? Well, that's what you don't
Half
need it
speed.
when you have
Half
Ryan
speed with
Dietrich
it,
on, Chief Market Strategist at the Carson Group, breaking it down for us. I don't know if we're going to talk before the Michigan-Ohio State game, but we will be chatting before the end of the year, Ryan. Thank you so much.
Thanks, guys. Appreciate it.
Thanks,
Take care.
Ryan.
Bye-bye.
All right. Wow.
We went green here, Joel. Ryan just talked the entire market up here. This is the Ryan Dietrich rally. It's a joke, but this is the Ryan Dietrich rally here. We just rallied 4 handles. Had me buying stocks too. I'm like, man, I better buy some stocks here.
We shouldn't be moving the market like this. We are green.
Ryan, you're just so bullish. You just moved the entire market up. We are joking here, folks. But we've had a nice rally since the jobs number, 830. Obviously, jobless claims were a little higher than expected. That has ignited the TLT, and what that has really ignited is the small caps to bounce back. At one point in time today, the IWM was down about 0.6%, significantly here. We are actually just went green here on the IWM. So clearly the market liking, at least from this perspective, the rally in the TLT. And what I've been talking about is the TLT driving the bus for the IWM. That is what has happened. We've seen a significant rally since that jobless claims number on the TLT, and IWM and the overall market is trying to follow suit here.
Do you guys think that we've had too long of a rally turnaround day, or what we've been looking for?
I'm not chasing it here. I'm with you, Mitch. I can't chase the market here. At this point in time, you got to wait for dips. If you're really uber bullish and we're going, strong to the end of the year, I think you will get more dips. A little bit of dip you had yesterday on a number of stocks. I do think dips are still going to get bought. The bulls are in complete control here now. Funny how it's turned from just 3 weeks ago. So I'm with you, Mitch. Can't chase here, but buy the dip, shoes are on.
Okay, S&Ps are just creeping up here. We are green on the session, a point off the high. We have a little disparity between the pre-market high yesterday and the regular session high. Remember in the morning I said, man, we sold off 20 handles. I don't think we're going to get back to that 41 1/4. So what the bulls need to do here is get us back up to in the 45.37 45.30 handle. The next intraday high is 45.37 1/4. So that's 16 handles, but I think it's going to be like chunk as people maybe taking some profits ahead of this rally. But tomorrow we got, as I mentioned earlier, we have the chief economist at the CME Group, Blue Putnam, who's been following this inflation picture with us for the past couple of years. He's been spot on. So we'll see what he has to say. This is we're going to wrap things up here on this Thursday and see if we can make it green.
Always good to have you. Of course, Dennis Dick, Joel Elconin, guys. You guys keep up with them. And, of course, the closing print at 3:30 with Joel Elconin. Don't miss it. Who will you have on today on the closing print, Joel?
I think it's actually me.
Yeah.
The man himself?
I know. It's
Yep.
me.
Yep.
I'll see you guys on
You
the
guys
closing
keep up
print
with
here
that. Definitely check that out, guys. All right, getting Joel out of here, getting Dennis out of here. Going to wrap it up, bring you guys over to live trading. That's coming up next. Don't go anywhere, team. We got a lot more for you guys today, and we do got a webinar today that's going to be important. Of course, what will we be getting into? A little bit of some mining action. That's at 11 a.m. Eastern today. Don't miss that. That'll be after live trading. So if you guys are into mining kind of stocks, maybe check that out. Lithium names will be on there. So come find out. I know they haven't had a good time lately. Hopefully they can tell us what they're looking for and how we can see a little bit of a turnaround in lithium. All right, guys, that's going to be up next, so don't go anywhere. And, of course, I'm ready to get into the trading action. Got a lot of swings on, 5 positions on. I'll be talking about on live trading. If you guys want to keep up with the action, like always, smash that like and hit the subscribe, guys. What are you guys waiting for? We need more of you guys subscribed. There's about like 40% of you guys that are watching this show and not subscribed. What are you guys waiting for? You get this information every single morning. And like always, Premarket Prep is here to get your day started. Like always, this is for informational purposes only, not to be used as investment advice. Opinions do not represent those of Benzinga, and hosts and guests may maintain positions in the securities discussed today. Now to bring you guys over to live trading, and let's keep the action flowing.